Well, by looking at the slide, you can tell that I'm going to talk about economics or the financial crisis, a topic that is far from our lives, abstract, complicated, and maybe a bit dull. But don't back off yet. Although not every one of you have heard of the financial crisis, I believe you have all seen one thing, a spider making a web. And to tell an astonishing fact, these two things actually share significant resemblance. First of all, let us imagine the dying corpse of a squirrel, a pretty disturbing image for us with a normal constitution, but for flies, it appears to be fruitful and prosperous, almost like a home that they would be willing to invest in or live in. Of course, they will flock to this location, since it is what they know and what they want. Unfortunately, spiders will get in the way. They will try to catch these flies using its webs and eat them. Whilst in the housing crisis, there was no actual eating involved, other than the words of those at fault. But spiders will try to catch as many flies as possible to get the best meal or payday. So they make the strands of web thicker in places that catches more or bigger flies, and they introduces new strands for the flies to get stuck to. But as time goes by, more and more flies get stuck on the web. But the squirrel also decays further and further. Its value goes down. But flies were already stuck on the web and unable to escape. We see diminishing return and sheer volume of interest, and eventually the web will break. This was exactly the case in the 2008 financial crisis. In the 2000s, investors were on the lookout for a low-risk, high-return investment, and they had their eyes on the US housing market. Like flies, they were lured by the carcass of the housing market, or mortgages, a type of loan used to purchase a home or other types of real estate. But dealing with individual mortgages was troublesome, so bank bought up thousands of these individual mortgages, bundled them up together. This bundle was called mortgage-backed securities. They then sell this security to investors. So by doing this, the house owners changed from owing money to the bank to owing money to the investors, flies owing flies. And at that time, the mortgage-backed securities looked safe for two reasons. Firstly, housing prices were high and rising, so the house could be sold for more money even in times of default. And additionally, credit rating agencies gave the mortgage-backed securities AAA ratings, which meant they were amongst the safest. So as a result, together with the relatively high rate of return, investors kept pouring their money into the mortgage-backed securities, and the demand for the securities increased rapidly. Soon, banks started running out of credible borrowers who were willing to buy houses. So, driven by their greed, the bank turned to subprime borrowers. These were people with low income and poor credit. Like flies, although lacking in the ability to pay back the mortgages, the wish of owning a house lured them into accepting the offer by the bank, and the securities made up of these mortgages were called subprime mortgages. They have another name called predatory lending practices, which means that these mortgages had adjustable interest rates, which were affordable at first, but quickly balloons out of their reach. So, as we can see here, the subprime mortgages contained various flaws, but the credit rating agencies could still point to historical data and show that these subprime mortgages were a safe bet, when in fact they weren't. But investors trusted the ratings and kept pouring in their money. Later, investors created an even riskier product called collateralized debt obligation, or CDOs. These were securities made up of even riskier loans, but given the same top ratings as the subprime mortgages. And as investors poured their money into the housing market, the increasing demand for houses drove housing prices up continuously, which made the subprime mortgages and CDOs look like even safer bets. And to make them even more reassuring, insurances were introduced. These insurances were called credit default swaps, which basically allowed people to bet on whether the subprime mortgages will go up or down. So, insurance companies sold millions of dollars worth of these insurances, which were then developed into other types of securities. The loop just went on and on. So as we can see here, the banks were like the spider, and the subprime mortgages, CDOs, and credit default swaps were like the hardly detectable spider webs. And the investors attracted by the high profit, as well as homeowners, lured by the incredibly easily accessible mortgages, resembled flies stuck in captivity. So in order to attract more flies, the bank or the spiders weave the web denser in areas that catches more flies. So more mortgages and securities were created, which causes even more flies to get stuck on the web. And this was like a vicious circle. But why was it vicious? I mean, isn't catching more flies something desirable for the spiders? Well, true. But don't forget, flies newly stuck on spider webs have one annoying feature. They flounder. And if the number of flies floundering together is large enough, chances are that the web will break. And this was exactly the case in the 2008 financial crisis. As we have mentioned before, the subprime mortgages were a type of predatory lending practice, which means they have low interest rate at first, but soon balloons beyond our ability to pay. So people just couldn't afford their incredibly expensive houses or ballooning mortgage payments anymore. Defaults started to take place, which put more money back on the market for sale. But there weren't buyers, so supply was up, demand was down, and the housing prices plunged. This affected even more house owners, since they suddenly have to pay for a mortgage that far exceeds their house current value. This led to even more defaults, which drove housing prices down even further. As the situation deteriorates, investors stopped buying subprime mortgages, and banks were stuck with bad loans. By 2007, big investors like the New Century Financial Corporation and Ameriquest declared bankruptcy. The incredibly complicated spider web, made up of all the low credit financial instruments, were finally broken by the floundering flies and the greed of the spiders. The stock market crashed. Companies declared bankruptcy. Some were forced into mergers, and others had to be bailed out by the bank. The US suddenly found itself at the heart of a deep recession. Therefore, in order to revive the economy, the government released a program called TARP, the Troubled Asset Relief Program, to bail out the banks and make emergency loans in order to prevent further bankruptcy. TARP injected $250 billion into the banking system and was later expanded to help others who have suffered huge losses during the crisis. Congress also injected $800 million into the economy, and the Federal Reserve lowered interest rates to near zero in order to stimulate lending and investment. So, what can we learn from the 2008 financial crisis? Well, the 2008 crisis was largely due to asymmetric information, which meant one side of the trade has more information than the other. This was the case between the banks and investors. Investors were unaware of the low credibility of the house owners, so they kept pouring their money into the housing market. And the banks were willing to lend to subprime borrowers because they planned on passing the risk to someone else or to be bailed out by the government. Due to these seemingly concrete routes of retreat, People let greed navigate the behavior and made unwise bets. Banks and credit rating agencies hid the risks. Investors were blinded by the high profit, and the government failed to supervise the system. The disastrous financial crisis was not the fault of individual groups, but the fruit of the irrational decisions of all people involved. However, were the mistakes in the 2008 financial crisis really that devastating and unforgivable? Well, true. The greedy financial agents were to blame. But we need to remember that the financial system was a system made up of humans who were known to make mistakes. The classical economic theories were based on the fact that all economic agents are perfectly rational, as opposed to us humans. We are emotional, greedy, and sometimes overly confident. It is in our nature to pursue interest, leave things to chances, and to think for ourselves. But this was not really a fatal defect. Webs could be rewoven after being broken, and the economy can be rebuilt after collapsing. In 2010, Congress started a financial reform, the Dodd-Frank Law, which aimed at increasing transparency and preventing the bank from taking up too much risks. The economy started to revive. So, although the economy can recover from economic crisis as time goes by, it is still better to avoid them in the first place. I mean, no one wants to break his or her limbs frequently just because they can be healed, right? So, how can we reduce the chances of suffering similar crises? First, let's look at two types of spiders. The first are the house spiders. They simply weave webs and passively wait for prey to fall into the trap. Later, they gobble down whatever they caught in their webs. The other are the jumping spiders. They don't use webs to capture their prey. Instead, when a potential meal is spotted, they creep closer to their prey patiently and conduct a calculated leap towards their target. Also, as a safety measure, jumping spiders always anchor a silk thread to their starting point in case the jump misses or if they are in need of retreat. The house spiders were like the banks from the 2008 financial crisis. They were brutal, greedy, and simply gobble down as much as they can catch. However, this type of hunting methods only focus on the benefits at present and lack thorough consideration on the whole. On the other hand, jumping spiders are more careful in their every move, and they make backup plans in case of failure and change their strategies when their attempts failed. This type of prudent mindset is what we should adopt. I know it sounds a bit cliché, but we should think twice before making decisions and pursue interest in a sensible manner. In this way, we can avoid the pitfalls of irrational decisions and the short-sightedness that led to the 2008 financial crisis. And we need to act more like jump spiders, calculated, prepared, and always aware of the bigger picture. By embracing prudence and foresight, we can make informed decisions that not only protect us in the short run, but also safeguard our future. Thank you for listening.